My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Internal Succession Readiness Assessments. Before we begin, let's cover just a few important items. First, please close any programs you have running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. The first is that you participate in 3 out of the 4 polling questions throughout today's presentation. And please note that GoToWebinar does monitor your participation in the polls. Next, you must complete an online evaluation. And if you registered for today's webinar through Transition Advisors, you'll receive a link to that online survey in an email from me later this afternoon. Once both of the requirements are met, the certificate will be emailed to you within 10 business days. Now, in order to fully participate in today's webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel. You should see it on the right-hand side of your screen. There's an orange arrow near the top that will minimize the panel. And during today's presentation, all of the participants are muted, but you can communicate with us by using that question box toward the bottom of the panel. Just type any questions you may have and click send. Time permitting, Terry will answer all of your questions at the end of today's presentation. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. You'll see some upcoming topics there, including valuing accounting firms, growing your firm through new practice niches, and one about mergers in September, the how, when, and with whom. Now, for a complete list of these webinars, including the links to register for them, you can visit the CPE courses section of transitionadvisors.com. Finally, I just wanted to remind everyone that you received a link to download a copy of today's presentation in the reminder email, but I just sent that same link via the chat function of GoToWebinar. So if you'd like to click on that for the PDF to follow along, you're certainly welcome to do so. Now I'd like to introduce our presenter for today's session. Terry Putney is the CEO of Transition Advisors. Thanks so much for attending, and I hope you enjoy the webinar.
Hello, everybody. One comment I'd like to make regarding the questions. I've kind of crammed about a 2-hour presentation into an hour today, so we're going to be challenged a little bit to get through the whole thing. If we're unable to get to any of your questions at the end of the webinar, I will answer those for you by email today. So don't worry about if we don't actually get your question answered. Just wanted to give a little brief introduction about Transition Advisors. We're a national consulting firm. We work strictly with accounting firms on strictly ownership transition issues. The 3 areas of service that we primarily offer are support for mergers and acquisitions, including looking for partners for you to merge into or merge into you. Creating the process and supporting the entire transaction, negotiations, and so forth. And also practice management services are associated with ownership, meaning succession planning, redrafting and restructuring owner agreements, and so forth. And we do work in all 50 states in the United States and also in Canada. I think everybody by now is aware that succession challenges are a huge issue in the accounting profession. According to the 2014 Rosenberg survey, 73% of partners in firms under 2 million are at least 50 years old. The average age of partners in firms under 3 million, according to the 2014 Inside Public Accounting Management Practice Management Report, the average is 55.6 years. And according to the 2012 PCPS survey, 79% of partners expect succession planning to be a significant issue for them in the next 10 years. Again, from that survey, 83% of all partners expect their firms to transition to their ownership to existing or incoming partners. However, 42% of partners believe that younger members in their firms are not ready for leadership, and 28% indicate their firm doesn't even have an owner agreement. So it's a problem that's facing the profession, and now it's exacerbated by the fact that we've gone from having a plethora and a surplus of labor due to the economic downturn in 8 and 9 to now we're facing accounting as one of the highest levels of employment of all professions. So it's firms are finding it a lot more difficult to find talent. With that, just to get us started on the polling questions, I'd turn it back over to Nikki for our first polling question.
Okay, the first polling question is on the screen. It's the number of owners and partners in your firm. So your options there, 1 to 2, 3 to 8, 9 to 20, or 21 plus. I'll give everyone about 15 more seconds to answer. And just keep in mind you do have to do 3 of the 4 polling questions in order to get your CPE credit today. Okay, it looks like nearly everyone has answered. We'll go ahead and close it here. Terry, it looks like about 2/3 of the folks on the line have 1 to 2 partners, another 22% in that 3 to 8 range. 7% are in the 21 plus category, and then the remaining 5% are 9 to 20.
Okay, I guess help me kind of position the presentation here. So I'm going to start off with introducing you to a firm that I'll refer to as J.S. & Company, who I recently did a partner retreat for, and we're going to talk about them and their situation in the context of the content of the presentation today, give you a little kind of a real-world scenario of how some of this works. J.S. & Company is a 4 equity partner firm. They have also 2 non-equity partners. The ages of the 4 equity partners is 62, 53, 52, and 44. And prior to the retreat, I did their concern was how are we positioned for succession, and that was the point of the retreat. And we did that over the course of a day and a half. We went through the retreat. Prior to the retreat, I interviewed each of the partners to find out what their perspectives were on kind of the big issues, what the hot issues were, where their concerns were. And I found out that the 62-year-old who managed about 40% of the firm's business and was the primary rainmaker was not the managing partner, but was really not ready to leave yet. Their agreement allowed for retirement at age 70, and he felt like maybe he would use that full 8 years left or not. I mean, he was open to whatever was right for the firm. The 53-year-old was kind of okay with the way things were, managed amongst the 4 equity partners the smallest book of business. 52-year-old was the managing partner, and she's 9 years away from leaving the firm. Really wanted to leave, in her early 60s, but nothing really pressing. And then the 44-year-old, to my surprise, and what turned out to be the surprise, actually indicated that he was probably not going to stay around for more than about 10 more years. So it was pretty obvious that we had, a few years of cushion here, but in about 8 or 9 years, 3/4 of the current equity group was going to be turning over. Unlike many situations I run into, there was no issue with their owner agreement. It was affordable. Everybody was comfortable with it. They'd used it before successfully. There was some concern about, making a proper transition of clients, and we'll get into some of those issues later in this presentation. But they also had recently been approached by a large regional firm about a merger, which is probably, I would say, way over the 50% of the firms I talk to that have the demographics of this firm have been approached by somebody recently and have been given the opportunity to consider an upstream merger. When we went through the analysis, the first thing we did, of course, was figure out with JS whether or not they could do this internally. And the big issue there was, the thing we had to deal with was, to what extent do we need to replace partners, and when do we need to do that? So in the course of the interview, of course, I was able to determine that we had what the time frames were. And during the course of the retreat, we were able to go through the analysis of how we were going to replace each of those people. The feeling was in that case that the oldest partner, who managed the largest book of business and who also was the biggest rainmaker, probably couldn't be replaced by just one person. When we talk about bodies, we probably were looking at least 2 equity partners and a very important role of rainmaker, which the other 3 partners, one was pretty good at it, the other 2 weren't so good at it, and so there was going to be an issue of role succession. Now, in some cases, we run into circumstances where we have too many partners in the firm, and we don't need to replace each partner that's leaving. I just talked to a firm the other day that had 6 partners. 3 of them are leaving, but they felt like they could probably manage the firm effectively with only 4. So in that case, we didn't need to replace all 3 that were leaving, probably just had to deal with 1. But of course, this was at the point in time when the 44-year-old informed his partners that he probably wasn't going to be around for 20 years like they thought he was. So as we went through the scenario of now we know what we need to do when we need to do it, with JS, the question was, do we have the clay to work with to get that done? You know, my belief is that it's at least a 2-year in order to properly transition a client base, you need at least 2 years to do that with the successor in place alongside the original client relationship person in order for the clients to feel comfortable that the handoff has gone well and that they're going to be served just as well as they were before. And in order to make sure the person that you're identifying as your successor is ready, there's probably at least another 2-year burn-in period prior to that. So I believe that that you got to have successors in place probably around 4 years to feel comfortable in advance of when a partner is going to leave, if that person is going to be that person's replacement. Now, typically, we're not talking about one person replacing one. There's a reallocation of duties throughout the firm, but in order to replace the body, you really need about that 4-year burn-in period. As we went through the JS scenario, we found we had 2 non-equity partners. We felt that one of those was probably a future equity partner, but the other one maybe not so much. We also felt like there were probably 4 managers that had potentially long-term could become equity partners. And so felt like, well, we've got some clay to work with. We don't really have a lot of room for error here, though. So, you know, we actually filled out this chart. This isn't the chart, the JS chart. This is a generic one. But in this chart, we've gone through and identified that a partner that we need to replace with the same, with another partner is a role succession, an RS, and a partner that doesn't need to be replaced would be a role reallocation, which is an RR. And as we look at this chart, we're able to determine when do we need people and how much do we need. In JS's case, we decided we needed at least 5 new equity partners in the next 5 to 6 years. There would be almost a complete turnover of partners within 8 to 9 years within the current existing group. But what really emerged out of that, even though that seems daunting, the thing that we couldn't overcome in the retreat was the fact that we couldn't identify who the next managing partner was going to be. Nobody that was at that table wanted to be a managing partner. Nobody could really say with any kind of certainty at all that anybody that was in that group of people that were incoming potentially down the road had that kind of skill set. It was obvious that that role was going to be very difficult to replace, which also was exacerbated by the fact that nobody could say who the next rainmaker was going to be. So we had 2 very important roles in the firm that we were very uncertain about replacement. So that led us, in JS's case, to the question, should we do this internally or do we need to look for an external solution? And keep in mind that somebody had approached them recently about that. And that's kind of where you are at that point in time when you've gone through the assessment for your firm. You're going to be in the same position. You kind of come to the fork in the road. Is this going to take us internally or is it going to take us externally? You know, the common challenges that firms face that they have to overcome. We've already talked about the bench strength issue, which always seems to emerge as an issue. But oftentimes, even with bench strength, if you haven't admitted a new partner in the recent past, you just don't know how to do it. What are the financial terms? How do we reorganize the firm around that? I mean, everybody has their duties. All of a sudden, we're going to upset all of that. How do we reallocate that? We've got affordability of buyouts. Our owner agreement might be one that no one has any confidence the firm can afford. The selling partners feel like, I'm not sure I'm going to get paid. I'm not sure I'm going to get paid enough. What's the market value? The buying partners feel like, I'm not sure I can deal with an obligation that's going to be the next 10 years and, you know, a big check every month. A lack of commitment to the plan. Oftentimes we have partners that have individual agendas that they're trying to manage. that really aren't in the firm's best interest, and so that means I don't want to change or I don't want to do that because that's going to hurt me, when in fact that may be what the firm needs. A poor transition of partner duties, and I especially run into this when we've had a bad experience in the past. For instance, may have bought a firm where the firm didn't know how to transition duties, and when that person eventually did leave, a lot of clients were lost, or maybe a partner that internal buyout, there wasn't a proper transition, and the partner never actually turned over any of the client responsibilities, and nobody knows how to ever make that happen. So that's a lack of confidence in how to do that is oftentimes a problem. Uncertain timing of retirements. If you don't have a mandatory retirement age in your owner agreement, you're kind of flying blind. Nobody knows when somebody's going to leave, and just waiting for that sort of the axe to fall. And then, of course, a lack of growth. Without a lack of growth, it's very difficult to admit new partners, which you have to have a constant flow of new partners into the firm in order to assure that your bench is going to be adequate when the time comes. So with that, I'm going to turn it back over to Nikki for a second for the next polling question.
Okay, the second polling question today is which best describes your firm? And you see the options there: looking to grow, considering near or long-term succession, or stay as we are. And again, this is our second polling question. You have to complete 3 in order to get your CPE. So I'll leave it open for about 10 more seconds so everyone has a chance to answer. Okay, it looks like nearly everyone has cast their vote. The results are there on the screen. 41% say they're looking to grow, 35% are considering succession, and then the other 24% stay as we are.
Okay, so we've got about almost an equal distribution. Okay, the third step, strengthening the bench. And this is, again, goes back, remember the second step was deciding whether we're internal or external. Let's explore further the internal option, which is what we did in JS's case before we made the decision, eventual decision, which just to jump ahead, was to look for an external solution. So in JS's case, what we found was that, we'd been doing, get caught up here, sorry about that. We had been always looking at the potential for long-term development of talent from within the firm, so that there was always new college students being hired every year, and that certainly is the way that most of us would prefer to do it. We're in control. We can, it's the easiest way. It seems like the easiest way to get it done, but it seems to be the thing that most firms, unless you're a very large firm, are struggling with these days. The second option, of course, is to hire near partner or partner level talent, so you get that instant solution. And the third is to look for the potential for that kind of talent in an acquisition or merger of another firm. Whatever you do, if we're going to go after, let me back up for a second. In order to go through the first step, which is hiring first option, hiring low experienced talent, or in other words, people out of college typically, or people with 1 or 2 years experience. One of the things that I find is that firms you wake up one day, you've got a whole bunch of doers, a bunch of technical people, but no leaders. And if you roll the clock back to when those people were hired, most of the time you're going to find that when they were hired, everybody knew they probably would never develop into that role, but they fit the role that we needed at the time. So we're basically making a decision to create short-term certainty in the outcome at the expense of long-term potential. So one of the things that I've asked firms to do is to establish what in their firm are the values and the attributes, characteristics of a partner in their firm, and then think about what the people they're hiring and whether or not they can picture that person that's sitting across the desk from them having these capabilities. And it's often the case that when you're dealing with somebody like that, you can look at them and say, no, I really can't see that. And you just can't afford to do that as much as we've been doing it up to this point. So here's just an example, and I'm not going to go through these in detail, but they're the obvious things that I think aren't difficult to really put in writing, but something you should have in writing and use as a tool for hiring and development purposes. When you make the decision that we just don't have the time to do that anymore, and we've got to go after an instant solution, which means finding someone who could potentially be a partner in the firm in the next year or two, oftentimes we're dealing with somebody who we're trying to pull away from a larger firm. So let's say, for instance, a firm like McGladrey, who's the 5th largest firm in the country, a senior manager at that firm. In order to get that person to come to your firm, you're going to obviously have to create a much better opportunity than they perceive that they have at McGladrey. Now, there's probably some unsettled, I'm using McGladrey as an example, there's many firms that fit this criteria. There's probably something unsettled for them within that firm. They don't see that as being a long-term great opportunity for them. But at the same time, they're not going to take a step back typically to come to your firm. So the 3 things that you need to deal with, and the things that I think are when I talk to firms about this potential, they have the hardest time coming to grips with, are first making a lucrative offer. Oftentimes, we're talking about making an offer that is outside the range of their normal compensation for somebody at that level, but you've got to create that kind of short-term economic opportunity. Very often, it means taking a step back, potentially in profits for the firm. If we're going to hire somebody with no book of business and we're going to pay them $175,000 or $200,000 a year, which is what we might be talking about in many cases, you're taking the risk that $200,000 isn't going to pay off. Now, I happen to believe if the person is the right fit, if they really do really have the capabilities that you think they do, they'll create at least that much new value within the firm. But you certainly have to be willing to take that risk. And I've oftentimes seen firms stumble over that very issue of, well, I really don't want to make that investment. And third is a solid plan and commitment for promotion to partner, so that's able to describe to them what's it going to take, how long is it going to take, and what's it mean when you get there. So being able to have a clear, concise conversation about, your owner agreement, your compensation system, what their role is going to be, how this is going to work, and here's kind of the quid pro quo of what it's going to take to become or what you have to do to become a partner in our firm and what we have to do. And then finally, if you want to go the route, and we oftentimes talk about this because we do so much work in the M&A world, about strengthening your bench through a merger and acquisition, the first thing you have to remember is that most firms that are seeking an upstream merger are doing it because they have their own succession problems. So the first thing you have to do is solve that problem for them before you can start focusing on what that means for you. You oftentimes are looking, if you're not experienced in mergers and acquisitions, you're going to find that you're looking at firms that have stuff you really don't want. There's always some baggage that comes with every deal, some clients, some staff, some situation that, an unexpired lease, something that you'd rather not have, but you have to be willing to work around in order to make the deal work. And then, what you're really looking for, of course, is diamonds in the rough. In the case of JS, they have diamonds in the rough. I mean, they had 2 non-equity partners. They have 4 managers that were considered very strong. I think given enough time, JS would be in a position to turn that coal into diamonds, but they didn't have enough time. So someone who acquires JS would find themselves with some talent that they could use for their own long-term succession, as long as they can deal with the 3 out of 4 partners that are going to leave in the next 8 to 10 years in that case. The other reason, or the other advantage of using mergers and acquisitions for talent development is if you're in a situation where you have staff that are maybe a year or 2 away, but you just aren't in a position, you haven't been growing, so you haven't been able to create the capacity for the staff to be developed and promoted to partner status. By giving your top line a jolt through a merger and acquisition, say you acquire $1 million book of business or even a $500,000 book of business, you might create enough new capacity as you transition that seller out for promotion of some of your staff, and you can accelerate their opportunity when you've been unable to do that through your own organic growth. And I'll turn it back over to Nikki for another polling question.
Okay, this is our 3rd polling question for today. You can see the question there is, my most likely succession outcome is, And your options this time are: I expect to be bought out by my firm, I probably will be bought out due to a merger or sale, I don't think I'll ever receive value for my interest, or I don't know.
And if you're not an owner in the firm or don't expect to be an owner in your firm, then probably should answer I don't know.
I'll leave it open for just a few more seconds. Again, this is our third of 4 polling questions, and you need to do 3 in order to receive the CPE. Okay, I've closed the poll. The results are there. Just about half say I don't know. And then we've got 22% at the I expect to be bought out by my firm. 18% I probably will be bought out due to a merger or sale. And then 11% for the final option.
Yeah, and that's a tough one, the final option of I don't think I'll ever receive value for my interest. You know, maybe that's, oh, whoops, what did I do there? Maybe that's okay with you, and or maybe you'd like to fix that problem. So let's talk about the deal. The deal being an internal buyout of, or what your owner agreement would pay in the way of partner retirement when it's time for you to leave. We're going to spend a little bit of time on this. We have some webinars that we've done that strictly focus on partner agreements, and if this is something that's important for you, I would encourage you to view those webinars or look at some of the articles we've written on this issue, and I'll give you some links at the end of the presentation to those on the specific issue of partnership agreements. The PCPS survey, which again, if you don't have that, there's 2 surveys. One's for multi-owner firms and one is for sole proprietors. And you need to be a member of PCPS, which I would encourage you to do, of course, which is a division of the AICPA. But that survey is extremely valuable. There's some tremendous information in it, and I use it all the time as a reference for what's going on in the profession on these issues. 37% of the respondents in that survey, of the multi-owner survey, indicated that they use a multiple of equity for the basis for valuing partner retirements. What that means is that we take a theoretical value of the firm, which is oftentimes defined as a multiple of revenues. Let's just, for example, say it's one times revenues, and multiply that number times an equity ownership percentage that's been determined on some basis. So if I own 25% of a $3 million firm, that's $750,000 if we use a 1x multiple. 16% use some valuation applied to a specific managed book of business. That tends to be the method that firms that are newer tend to use. I mean, when we first get started, oftentimes if we're merging together, say 2 or 3 books of business into a firm, we might say the value in the event of a sale is going to be based on our individual managed book of business, and then over time we'll probably transition to a different method. 22% use a multiple of compensation, which we'll talk about what that means in a minute, and then 25% use something else, which may be a stated value or maybe some other formula that doesn't fit in one of those 3 categories. Keep in mind what we're talking about typically on these valuation methodologies is the intangible value of the firm. So this would be what some of us might call goodwill. And then the tangible value, which would oftentimes be the accrual basis book value of the firm, would be in addition to that. So if I have a accrual basis capital account of $200,000 and my portion of the firm's revenues allocated to me through the owner agreement might be $1 million, I've got a total of $1.2 million of value in that situation. Of the ones that are using a multiple of equity or book value, in other words, valuing the book of business, about 8% in the survey are more than 100%. About 40% are using 100%, and about around 30% are using something between 75 and 100, and the rest are actually below 75%. The trend is clearly in the profession to decrease valuation multiples. There's no question that if you took the same survey 10 years ago and it wasn't done 10 years ago, you would have a lot higher multiples out of the survey. But due to the pressure that succession is putting on a lot of firms, they're wanting to take the pressure off of the the payment obligations. Firms are regularly now decreasing their multiples, and that's part of the reason why, one of the projects, or one of the things that we do for firms to help them figure out what the right number should be. The other thing to keep in mind here is, and this is surprising for a lot of people, is that internal valuations are almost always going to be lower than an external valuation as it comes to the multiple of revenues. So if you're feeling like, well, in my market, we're seeing multiples of around 1 to 1.2, say, which might be what you might see in a very large metropolitan area. That doesn't mean that an internal valuation should be that high in your firm. One of the reasons for that is that the rest of the terms that go along with the buyout will be substantially different in an external deal than they will be in an internal deal. For a lot more information about that, I would suggest that you look at some of the articles we've written for the Journal of Accountancy on how to value in an accounting firm in an internal transaction. For firms that are using a multiple of compensation, and if you're not familiar with that, what this means is that let's say I'm making $250,000 a year as a partner in the firm, and we have a 3 times multiple, typically that means I'll take 3 times $250,000 or $750,000, and that'll be paid to me over time, oftentimes 10 years. So in that scenario, I might be paid $75,000 a year for 10 years, and that's how my quote intangible value would be determined. Of the firms that are using this method, about 40% are using 3 times, and again, I'd say 10 or 20 years ago, it was almost always 3 times, and now it's less than half the time is now 3 times. About 15% are using 2.5 times, and about 15 to 20% are using 2 times. There are some using 2.75. I've seen 2.25. I've seen 1.5. I've seen 1. So there's definitely some lower valuations, and there are a few still left out there that are at 3.5 or even 4. But it's very rare that I've seen that kind of multiple anymore. In the Rosenberg survey, the 2014 Rosenberg survey, they asked the question of, what percentage of revenues, regardless of what method you use for determining that, which means including compensation methods, what percentage of revenues is your goodwill valued at? And the average for all the firms that responded is 80% of revenues. So if you're going to look at the profession right now, that's a good place to say, okay, 80% of revenues is where maybe we ought to be looking at. Using the firms that are using the multiple of comp buyout method in the Rosenberg survey, for those that are under 2 million, it's about 1 out of 5 firms uses that method. For those that are over 2 million, it's almost 50%. So that method tends to work better in a larger firm where we have less emphasis on a managed book of business. And in a smaller firm where that tends to be more of an issue, oftentimes that's why we're still looking at using revenue multiples as and even a managed book of business, which might be a proxy for equity in many cases. That's the reason smaller firms use that. In JS's case, I mentioned that this wasn't really an issue for them. Their value worked out to be about 90% of revenues, but it worked out to about 3.5 times comp. We still felt it was affordable, but it was certainly on the higher end of what a firm that size you'd see nowadays. So when evaluating your situation and your agreement, we suggest you use what we call a backwards valuation approach, which means that you're rewarding your retiring partners for all their years of sweat equity. You want to have a fair deal, but at the same time, you shouldn't be asking the people that are left to either take a step back in compensation or have to borrow in order to make those payments. It needs to be self-funding. Well, how do you determine whether it's self-funding? Well, the available capital is the partner's foregone compensation. What was the retiring partner making before they left when they were a full-time partner? And we're going to use that capital for 3 things. First thing is we got to pay them their buyout. The second is we have to replace their labor. And the third is that we have to have some upside left for the partners who will be assuming the obligation and all the extra work that comes with paying off a retiring partner. So as an example, let's say we've got a partner who's making $300,000 a year. We might decide that their replacement resources, the cost to replace their labor is $120,000. Usually the rule of thumb I use is if we take the production, their billable hours, assuming that they're a normal line service partner in your firm, take their billable dollars, and let's say that's $300,000 that they're producing on their own time. That times 40% might be the cost that we might estimate it would take to replace those billable dollars, regardless of who's going to do it. So in this case, we've got $180,000 left of capital. So let's work through an example here. Let's say the firm volume's $1.9 million. We've got a partner who's leaving with a 45% interest in the firm. And they're making $275,000, including their benefits, at a $175,000 accrual basis capital account. If you take assuming that they had a deal that paid them 1x over 5 years, if we take 1.9 million times 1 is 1.9 million times 45% is $855,000. Then paying that out over 5 years might be $171,000 per year. Usually there's not interest paid on those payments, although sometimes there are, but that changes the equation, obviously. And in this case, we assumed that the cost of the replacement resources was about $125,000. So how does that work out cash flow-wise? Well, the first year, we've got $275,000 less the $125,000 or $150,000 to work with of available capital. We're going to pay $175,000 for the capital account because it was all due, within a year of the retirement under this particular agreement. And we're going to pay $171,000 for the retirement payments. That's going to create in the first year $146,000 of negative cash flow. Even though we're paying the capital account out, and you can say, well, that belongs to that partner, the clients are going to stay. The need for that capital is going to remain because a substantial portion of it's receivables. And so we're still going to have to replace that capital get the cash flow from someplace. So in this case, we've got obviously a significant problem. And then in the next 4 years, we still have a problem because we're paying we've got $150,000 left to work with, and we're paying $171,000 of buyout payments. And so this firm and these partners are somehow going to have to come up with about $250,000 of negative cash flow during the 5-year buyout in order to make this plan work. I see a lot of agreements that are structured this way. So in order to fix this, what I would suggest in this case might be to pay the capital instead of over 1 year, to pay it over 5 years. Instead of paying the retirement over 5 years, to pay it over 10 years. We'll see how that works. So in that case, we go back, we have the same scenario, we've still got the same $150,000 to work with. Now we're paying $35,000 each year for the capital account, and we're only paying $85,500 each year for retirement. We've created $29,500 of positive cash flow in the first year, and then in years 6 through 10, we've created $65,000 of positive cash flow. And how much the positive cash flow should be, there's no right answer to that, but at least now we know that this particular agreement is self-funding. So one of the biggest problems I see, once we get past the fact that there are still some agreements that have valuations that are too high overall, is trying to pay out too much too fast. And if we stretch the payments out, we're not asking anybody to take a significant hit. Obviously, you'd rather have your money quicker, but you're still going to get it, and making it much more affordable for the firm. Another issue that we run into is the transition plan of firms saying, well, gosh, I don't know whether we're going to be able to transition all of these clients adequately, and what's going to happen if we don't. The first thing that you need to make sure is that your agreement requires adequate notice, and I would say that's at least 2 years notice of intent to retire. There's a lot of agreements written by attorneys because all they're thinking about is, they're not really thinking of the business plan. They're really thinking about kind of legal ramifications, and they might say, well, you only have to give 90 days notice. I've seen agreements with 60 days notice. And if you think about it, if your partner walked in and said, I'm leaving in 90 days, what are we going to do? You're kind of stuck. You need I would say at least 2 years notice of intent to retire. You need to tie the notice period to the transition or the duties to hand off. Need to be able to identify a successor for all those duties, and deal with the fact that you might have some potential double comp while you're going through that transition, and just rather than worry about, I mean, if the person's working substantially less hours during those 2 years, that's one thing. If they continue to work full time, you just really need to absorb that the impact that might have on your partner comp system as a part of the investment, and making sure that you maintain the firm's volume. One of the things that we've started doing, because firms have had bad experience with transition in the past, is creating a formal transition plan at the date that the notice is given, and requiring that the retiring partner execute that plan, or else be subject to the fact that their deal might become contingent. So, for instance, we give the transition plan to the partner. In that plan are very specific steps, and in fact an attached list of who your clients are and who's going to be your successor. And there's, in that is obviously the steps the retiring partner has to go through in order to make a proper transition. If they are failing to do that, they're given notice that they're failing to do it, and if they continue to fail to do it, then the firm is able to pull a trigger that says your buyout is no longer going to be fixed at the date of retirement. It's going to be contingent based on retention, which might be tied to the book of business you're managing, or might be tied to, depending on what your duties are, some other means of determining lost business, but in essence making the deal contingent. And what we find is with that, both sides tend to create a lot of confidence that the transition plan can be executed. With that, we'll go to our last polling question.
Okay, our fourth and final polling question's on the screen. This one is, my biggest concern about my firm's future is, with your options being affordability of upcoming retirement, replacing retiring partners, retaining retiring partners' clients, or I don't have concerns about succession. I'll give you about 10 more seconds. Okay, it looks like we have nearly everyone's voted. I'll go ahead and close the poll here. And the results are on the screen. 39% say they don't have concerns. 24% are concerned about replacing retiring partners. 19% retaining retiring partners' clients, and the remaining 17% affordability of upcoming partner retirement.
Okay. And I just add one thing on retaining retiring partners' clients. If the nature of the client base is such that it's so specialized that it's going to be difficult, then you may need to vary from your standard owner agreement with respect to that particular partner and make the deal contingent. So there are situations, for instance, where you might have a very large client who appears to be very closely connected with that individual partner, and there's uncertainty about whether or not that client will stay when the partner leaves. Well, the deal's got to maybe become contingent. So that's one approach to that. Of course, doing that then brings everybody back to the table to say, how do we overcome that? What kind of transition plan can we go through to make sure that doesn't happen? But sometimes that's the case. I'll quickly take a question that was asked here. Is there a way to make an existing employee a partner who in every other way would be a great partner but will never become a CPA? Well, the first thing, of course, to consider here is what state you're in. And there are still, I think there's a handful of states, New York being the largest of them, that does not allow for equity to be owned by a non-CPA. So assuming you're in a state that allows for up to 50% ownership by non-CPAs, and of course you can ignore the non-CPA issue. If you're, if that's not a problem, then you can have that person own part of the firm. The other option, of course, is to make them an income partner or non-equity partner, which always can be the case. I think the thing I get concerned about is if the person isn't going to be a CPA because they don't have the training, they don't have the education, they don't meet the education requirements, they don't provide services that require CPAs, maybe there's some like a technology consultant or something. That's one thing. If the reason they're never going to be a CPA is because they just don't want to invest in that, or just really never, they took the test a few times and never passed it, I think that's a a character flaw in my view, and I would be reticent to relax the standards for that person for that reason. I mean, it's not that hard to become a CPA. Most of us on the line have done it. So when we look at the external options, let's assuming you get through all this and decide, like JS did, that we aren't going to be able to pull this off. You know, the question is, when do we start? You know, you always need to give yourself enough time to transition to practice. And so, you know, if you have that much time, you need at least 2 years to be with your, you know, successor firm in order to have a proper transition to clients. It's no different than an internal transition. In fact, it's even a little more stressful, challenging in an external deal than it is in an internal deal. One of the things to keep in mind here is that market prices are coming down. Firms are becoming much more selective, the ones that are buying. And so, you know, the longer you wait, the more risk you're running that what kind of market are we going to have in 2 or 3 years. So in JS's case, even though we didn't really have a significant problem facing us for probably 4 or 5 years, what we didn't know was what the market would look like in 4 or 5 years. And every year that goes by, a firm like JS becomes less attractive because they become closer and closer to a succession emergency, and firms, larger firms now, are much more reluctant to take over succession emergencies. So when you walk in and say, gee, I just did my last tax return, somebody take this thing off my hands, there are, you know, depending on the size of your firm, there may be very few firms that are willing to accommodate that kind of situation. There will always be, in the case of small practices, and I'm talking about primarily sole proprietors here with practices that are, say, $1 million and under, there will always probably be a market for the volume that acquiring that practice will create. Most of the acquiring firms for, say, a $750,000 practice are going to be firms that are somewhere between 3 and 10 times that size. And those firms are the ones that oftentimes struggle with their own organic growth. And therefore, they look at an acquisition as a way to maintain substantial growth in the firm, create value for the existing partners, and create capacity to bring in new partners. So in those cases, that's primarily a volume play. Now the question is, what kind of role are you going to play with them during the transition period, and how long is that going to be? With larger firms, what we're finding are that they are very much more emphasizing niches, specializations, strong operating metrics, and a low pressure from succession needs. They don't want to take over a situation where 3 of the 5 partners are going to leave in the next 3 years. So firms that 5, 6 years ago would have been plums to be picked up in a merger by a larger firm are now being rejected, because not only do they not meet that criteria, but there's a plethora of other opportunities out there for larger firms to talk to. I had a partner, a managing partner of a $35 million firm the other day tell me that he's looked at 12 opportunities in the last 3 months. This is the minimum that this is the maximum in terms of deal terms that I'm going to offer. And if they don't know that, if they don't agree to that coming in, I don't want to talk to them. So that's an indication of how weak the market has become in some cases with some size firms, because primarily in that case we were talking about firms that were in the $3 to $5 million range. Certainly the supply and demand curve is now shifted in favor of the buyers, because there's just way more sellers, and there are still there's strong interest from the buying. It's mostly the fact that there's way more sellers now than there were 5 or 6 years ago. But other issues that are causing the market to shift are tighter credit, which is starting to loosen up some, but still an issue in some cases. And what's really an issue is a tighter labor market. The fact that the more people that have to be replaced in an acquired firm, the more pressure that puts on what might already be an issue for that firm, which is finding available talent. When you're looking at external options in order to maximize your value, it's all about retaining clients. It's all about, and if you're a seller, keep in mind the 4 C's. Those are chemistry, culture, capacity, and continuity. That's what you want to look for in a firm that you're considering as a potential buyer in order to make sure that you're talking to the right firm. And again, I'll give you some links here to more information about valuing and your firm in mergers and acquisitions in a second. A couple things I'd point you to. The journal we wrote for the Journal of Accountancy a series of 12 articles from July of 2013 to June of 2014 on succession planning. It covers all issues that we've talked about today, including valuation, partner agreements, transition plans, and so forth. You can download that from our website. And we also did a series that followed that up in the fall of 2014, strictly based on valuation of CPA firms. So there's an article on small firms, an article on valuing large firms, and an article on internal valuations. There are webinars that you can access on our website, which include, there's many of them, that these are past webinars that you can access the recordings of. And in fact, this one will be on our website, and you can forward this to some of your cohorts if you'd like, if you feel like they should listen and watch this one. Innovative approaches to M&A deal structure in the event that you're looking to merge up or sell. These are just two examples, and how to value your accounting practice. Again, you can get that on our website. I'd also point you to a new source on the AICPA website, which is the Succession Planning Resource Center. We provided a significant amount of the content, but not all of the content for this. And in here you'll find tools for doing your own assessment of your situation, helping you with when to get started, what you need to do, and then some practice aids for how to actually execute the process. Finally, I'm a member of the CPA Consultants Alliance, which is made up of this list of people, many of which I think you'll recognize. And there are 3 articles that we have recently published on the CPA Consultants Alliance website. The first one was on leadership and how the problem firms are having with communication. Second, on measuring happiness at work, which is primarily around retention of staff and also partners. And then the third one, which we just released this last week, is CPA firms face considerable succession challenges. And that was based on a nationwide survey that we did of CPA firms. So again, I would point you to the CPA Consultants website. And with that, I'll turn it back to Nikki to wrap us up.
Okay, thanks, Terry. We did have a couple questions come in. Would you like to address them with the time we have left, or would you prefer to do that?
Do we have time left? Yeah.
We do. It's scheduled until 11, so we do have a few more minutes.
Oh, we do? Okay, I'm sorry. All right, I thought we were going to 10:50. All right, go ahead.
So the first here is, what about the case where a partner has a life event where 2 years' notice can't be given and they need to cash out?
Well, your agreement needs to deal with all the different types of terminations that can occur. So, if it's death or if it's disability, which sounds like this might be one of those two things, although it could be something where it's a problem with a family member who might have, where you need to move or just need to become a caretaker or something. Your agreement should deal with all of those eventualities, and each situation is different. So with death, I mean, anytime you have an abrupt loss of a partner's role and position, you're going to have disruption in the firm, and it can be significant. If you're in a small firm, you've got 2 partners, and one of them has to leave all of a sudden. Needless to say, that's a big issue, and you're probably going to lose some business. So, if you're talking about the kind of disruption, for instance, that's caused by a death, you can insure that event with insurance. And so even though the deal might become contingent because the remaining partners say, look, we don't know what will happen if one of us dies. The estate of the person that could die can insure, in essence, the value that they place on their interest in the firm through insurance. Disability, you can get a little bit of that through insurance. It's more difficult in terms of the buyout because even though buyout disability insurance is available, it tends to be extremely expensive. I see very few cases of where it's used, maybe 1 in 25 or 30 cases where firms have used buyout disability insurance. In that case, I think what you're dealing with is just the fact that it's probably not any different than somebody walking in and quitting. And it's unfortunate, but typically in a situation where you're unable to give adequate notice, the deal probably has to become contingent. And so the firm will do its best to keep the business. I think everybody wants to keep the business, but if the capacity's not there, if the people aren't in place to take over, then, who should bear the brunt of that? I guess, unfortunately, it's probably the person that's selling in most cases. So we try to deal with all of those eventualities. We walk through case, examples of how this is going to work, but oftentimes it comes down to what's an appropriate way to make the deal contingent so that, and this is primarily as it relates to smaller firms, we protect the firm's viability.
Great. Thanks,
Next
Terry.
question.
The next question is, have you ever seen a one-owner buyer give a small equity position, 5 to 10%, to a seller in lieu of 5 to 10 years of high-level mentoring and stability of client transition?
I'm not sure I quite understand that. You're saying, I guess, you've got a, can you repeat the question, just make sure I understand it?
Sure. It says, have you ever seen a one-owner buyer give a small equity position, 5 to 10%, to the seller in lieu of 5 to 10 years of high-level mentoring and stability of client transition?
Well, certainly I think what you're referring to is a merger of small firms. If you've got you're one owner firm and you're thinking, I really don't want any partners, but here's an opportunity to acquire this firm, and I don't mind having a partner in this situation. Of course, if it makes sense, if the trade-off makes sense, the 5 to 10% makes sense in terms of value, then we do that all the time. I mean, it takes you to a whole nother level in terms of complexity in your organization, because now you have the need for an owner agreement when you didn't have that as a sole owner. You now have the need to deal with all these succession issues. Who buys out whom? If the majority owner leaves, is it realistic to think that the minority owner is going to buy them out? But that has to be dealt with in the owner agreement somehow. So you've got to deal with a lot of issues that you wouldn't have to deal with as a sole owner. But certainly whatever makes sense to both parties. If the seller's saying, look, it's more important to me to be in the environment that you've created. I have a lot more stability. I feel like I've got more backup and support. The money part of it's not as important to me as the intangibles that come with that, the lack of stress, the lack of uncertainty. Then, if the 5 to 10% is a nominal type of value, that might make sense to both parties. So, we've seen that kind of thing happen.
Okay. And then, Terry, could you just briefly address, we have several more questions, but if you could just briefly address this one, and I know you'll do the others via email. How do you handle a partner who would like to continue, but at a greatly reduced hours and responsibility?
Well, it depends on how your compensation is determined. Ideally, again, there'd be a quid pro quo for that trade-off. So if you're going to reduce hours substantially, reduce responsibilities, there's a way to have an appropriate adjustment in the compensation. If you've got a compensation-based buyout agreement, let's say you're paying 3 times comp, oftentimes those are defined as the highest 3 of the last 5 years. That gives you 2 years of transition time when the partner's compensation can fairly be adjusted downward without affecting their buyout. And I think that's obviously the reason to do the highest 3 of the last 5. But you need to have some way in your compensation system to adjust the comp fairly. If you don't have a performance-based compensation system now, you're going to have to probably create that in this case and negotiate what's a fair adjustment. But, if they're working half as much as they were before, it would make sense to me they might make half as much. So we usually look at it and say, once you get to 50 to 60% or lower full-time, you probably shouldn't be an equity partner anymore, and you should probably go into buyout phase. And at that time, if you continue to work, then it should be on a per diem basis, which might be defined as a percentage of your billable rate, maybe 33 to 40% of your billable hours, or billable time times your rate. But if you're talking about an adjustment down to say 70% or something like that, then ideally you'd be able to adjust the compensation on a pro rata basis.
Great. Thanks so much, Terry. And again, those of you who submitted questions that we didn't have time for today, Terry will answer those via email. You'll also get an email if you registered through Transition Advisors. You'll get an email from me later this afternoon. That will have a link to the survey that you'll complete online in order to receive your CPE credit. And then Terry will send a follow-up email likely early next week that will include links to some of the articles that he referenced today and a recording of today's webinar in case you'd like to watch it again or share it. All of that said, thank you so much for attending today's webinar, and we hope that you'll join us for a future one as well.